Our next speaker is Willy from WeFinance.
Hi, everybody. My name is Willy, and I'm head of all our marketing and growth efforts at WeFinance. I'm going to tell you a little bit about us. We started early last year, but to give you a background on why we came to be, I'm going to start off and tell you a little story about my co-founder. His name is Eric, and he's a little bit of a data nerd. Went to Stanford for undergrad and got his PhD there as well, and ended up working at Facebook. And while he was there, he was doing a good job of taking some of his savings, putting it away in his 401k, but he still had a substantial amount that was just sitting, earning next to nothing, about 1% on his savings, if he was lucky. Enter his friend, we'll call him Brian. He's a new lawyer, just graduated from University of Michigan, top law school, also went to Stanford undergrad, and he's paying 8% on a student loan that it's going to take him at least a few years to pay off, even in a great job as a lawyer. And another one, we'll call him John. He's a startup founder. Went to Harvard for a PhD, dropped out to start a company, and is actually accruing some credit card debt because he's working on this startup, 15%. And there's something that's clearly off here. There's a disjunct. And the reason for that is we have the system of government and private lenders, and all of their actions are based entirely on credit history today. And it's, especially for young borrowers like John and Brian, it's not enough for them. And there's a high overhead to the way that loans are made today by banks, by government lenders. And there's no adjustment for when risks change for borrowers. And what you end up is with lenders, potential lenders who have savings, making next to nothing, while borrowers are on the other side paying much higher rates than their risk actually is represented. So as you can probably guess what ended up happening here, first, and to talk about Eric in this particular situation, one of the big advantages is that he knows these guys. He knows their risks. He understands that they're trustworthy and reliable people. He actually wants to help them. He realizes that there is a way that he can help, and that's going to drive some of his decisions. And he's not a bank, so he's not a financial institution. He doesn't have as many great outside options for what his money can do for him. And lastly, this type of relationship where people know one another, there is that social pressure to repay and be held accountable to one another. And in this situation, what ended up happening was that Eric lent the money directly to his friends. And instead of Brian, the law school grad, paying 8%, they agreed on a 4% rate. They agreed on a 4% rate, and his startup founder friend, who had credit card debt at 15%, ended up loaning him the money directly at 6%. So the thing is that this situation is not unique. There are people out there who may not be in the direct network in the way that Eric was, but borrowers and lenders alike, where lenders are not making enough money on their savings, and borrowers are not accessing rates that are fair for them. So if there's a way we can actually connect these, use the social graph to actually spread the risk through these networks, and also benefit both sides, we can actually see ourselves creating something where people can transact with one another directly. And that's where WeFinance comes in. So today we are a platform for crowdfunding loans where borrowers and lenders can come together and leverage their identities, real identities, and their social connections to be able to access financing at lower rates that benefit both sides. And we also fully automate the loan management process, both the disbursement and the repayment of these loans. So today, here's what a listing looks like. You come as a borrower, you create a listing, you have your photo, and you tell your story. You share your listing with your network, and people can come in and pledge to you at the rates that you set. So to tell you a little bit more about where we are today, we've been running some test batches over the last year, and right now we just publicly launched a couple weeks ago, and have over a couple $100,000 right now that's fundable on our platform. And we're looking to grow very quickly over the next few months. We're currently focused on MBA, JD, and other master's grads. We have a growing presence on 5 different university campuses around the US today. We haven't had any late payments yet. Granted, it's only been since June of last year. And around 2/3 of our borrowers that have listed today are getting successfully funded, meaning they're hitting their minimum goals that they set before they tilt and actually fund, similar to a Kickstarter. There's a lot of potential here to go beyond just the capital that you can get in your network. It's obviously recognized that there are some capital needs for borrowers that exceed what they can find in their networks. So looking ahead to future models, one of the really interesting things that we've been thinking about is how you can use socially crowdfunded loans and supplement those with conventional loans that are actually at subsidized rates using the data and information that we've captured from people's social networks. So you can see an $100,000 conventional loan at 8% getting refinanced, 60% of it or some percent of it from their own network, and then the rest coming from another source, whether that's us or another partner lending organization. So the way that the online lending landscape has really developed over the last few years, I mean, Lending Club and Prosper really kind of laid the groundwork for bringing underwriting online and becoming a more efficient avenue to deploy capital to borrowers. And you see an evolution now of a few players who are trying to incorporate data with that. You see SoFi, Common Bond, Earnest. They're all combining things with education, work history, what balances you're carrying in your bank account to really progress the underwriting models to become more and more sophisticated. And where we come in is we want to integrate social into that because we think there are huge implications from what your network and relationships say about you and your creditworthiness. And what we believe that we can lead to are lower rates that others can't provide, lower defaults because of the social connections, and lower acquisition costs because we are a social-based platform where people are actually sharing and talking about their finances in a way that nobody else in the industry is doing. Where are we starting today? We're starting with student loans because they're the easiest to talk about, and also other types of loans, whether it's living expenses or credit card refinancings for these young, low-risk borrowers. But there's great potential going forward where we can see adjacencies in potentially moving down the credit spectrum and also providing other types of financial services once we have this network developed. So here's our team. Our CEO is a former Facebook PM and got his PhD from Stanford. I have a background. I was working at Credit Karma and Kiva before this and focused on all the marketing growth efforts. This next part would usually be the part where I tell folks that we're raising a seed round this year. But with that, I'll open it up for questions.
Thank you very much. That was really interesting. My question has to do with the actual default rates. I think I had read, is there any information on specifically what those specific segments are? Obviously, they're going to be lower than the entire population as a whole. But I think I read, I think it was this week, that obviously we're hearing about the potential bubble of the student loan problem, and I think it was something along the lines of 30% are not an outright default, but are late on their payments, which is not a great sign. Do you have any sort of data that would suggest, specific data for the JD MBA, which would intuitively have a lower default rate?
Yeah, so the entire business models of some of these players like SoFi and Common Bond is built on the fact that federal student loan rates, they don't adjust for the fact of where you went to school, whether you completed your degree, and they don't adjust for when there are changes in your risk profile. So whether you landed a job, all those things. So I don't have the actual numbers, but I do know that SoFi and Common Bond, SoFi just recently I think was featured in an article where they basically said of the 20,000 borrowers that they've had on their platform, only 2 have defaulted, and it was because they died. And the way that they do this is obviously they have a lot of flexibility in terms of when things go bad. They have, for example, unemployment insurance. They have ways to basically extend and change the payment terms to be able to claim the low default rates that they have. But their history is what's kind of, it's intuitive that people graduating from top universities versus people who aren't even completing their degrees should have different rates. But today, from the government, are accessing the same.
Seems like it would be interesting to explore how you could get some intergenerational relationships here, and the reason is because people at different times in their life are at different cycles in terms of what they're investing or they need the money, and odds are high that if you have student loans, probably your close social media friends also have lots of student loans, but other folks later might be a different point on the curve.
Yep, and that's a great point, and that's why we think at least the second piece that you noted is that the people whose networks have similar needs, that's where we can come in with lower borrower acquisition costs, which is really important for this industry. But we are seeing a lot of these like familial / generational, like older generations lending to younger generations on our platform, and it's definitely a big part of what we're doing.
Yeah, SoFi had started with that, and there initially was this alumni pitch, and they found out that they had many more people seeking money than they had providing money, and that's when they decided to go securitize and ended up as they are today.
Yep, and I think that and the reason why they moved away from that model was really to scale up with the source of institutional capital. But I think what they left behind was the fact that there are real benefits that can be gained by everyday people, as opposed to just providing all this interest to these institutional fund sources. We want to be able to say, not only can you access great low rates, but you can actually provide the benefits to your own network. And we would love to have all of our borrowers paying interest to people who they know and can benefit, as opposed to a faceless bank organization, other sources of capital.
Can you comment on how collections work?
Sure. So
you castigate. You have like a big dunce cap you put on their Facebook profile, or
hopefully we don't need to get to that. Any sort of that. I think it's built in today. At least the pressure to repay, because the fact that multiple friends or family or people who are even 1 or even 2 degrees away from you, your reputation is at stake. But at least on the collections piece that you asked, today we don't have formalized collection activities. We think that because of the network-based lending that this whole platform is built on, if someone runs into a situation, we'd be the first to know, because we automate and we manage the payment transfers, and we'd want to facilitate conversations where we can find out, are there ways we can change the payment terms similar to what others have done. We think that we've eliminated the sense of moral hazard where people will come to the site, get a loan, and run off with the money, because of the fact that the people that you're borrowing and lending money from are people that you have some sort of connection to.
Hi, Willy. Obvious question, how do you make money?
It's a great question. Yeah, today we're not charging any fees, but you can imagine, and others in the industry have proven that you can find a way to charge the borrowers and the lenders, borrowers for the access to the capital and lenders for the servicing. And since we take care of both of those, that's somewhere down the line we could definitely see that. The other key piece was that kind of supplemental lending model that I was talking about, where people are crowdfunding sources from our platform and then becoming traditional customers of other financing sources, whether that's us or another institution. And it could either be a customer lead gen fee, it could be the interest that we make if we become a lending organization.
So TBD.
TBD.
I guess my question is kind of boring, but do you foresee any kind of regulatory challenges or hurdles along the way? Because I'm sure you know, like, conventional banks are heavily regulated, especially after what happened a few years ago.
Yeah, and that's definitely something that's at the forefront of our minds constantly, because luckily there are a lot of others that are paving the way to allow this kind of lending to take place. But it is something that we're thinking through, and it's the way that we're structuring the activities that we do today. We want our product today to be considered loans, because they are loans between private individuals. They aren't securities. We're not looking to provide liquidity to our lenders. We're not looking to cut these up into little pieces and sell them off. This is really about leveraging your network and providing a way for borrowers and lenders to transact directly. But down the road, I mean, we do have to think about, do we need to get licensed with the SEC? Do we need to get a lending license on a state-by-state basis? But that'll depend on our later business activities. But it's definitely something that we're constantly thinking of.